Hello, good morning, good afternoon, and good evening to all of you joining us today. And we really welcome you for our today's masterclass. The topic is AR in Asia, Strategic Outlook for 2021. And for a masterclass today, we have our speaker, Simon. Simon Littlewood is based in Singapore and has been writing, broadcasting, and advising businesses worldwide on growth and cash flow for more than 35 years. Simon is an Oxford philosophy graduate who has written for numerous business magazines and periodicals, including The Economist and the leading Wall Street financial paper, Global Finance. Simon is also known to many in Asia for his morning broadcast on the BBC World Service Business Matters, which has an estimated global audience of 70 million in nearly 40 countries. Simon says, getting paid on time is an existential issue for businesses, large and small. It is not fancy technology or market share that determines the survivors, but the ability to develop deep customer relationships based on trust and transparency. Never mattered more than in a post-COVID 2020 year. Over to you now, Simon. I wouldn't take much of a time to get started with your masterclass. Thank you.
Thank you very much for that generous introduction. Yes, I've been helping companies get paid worldwide for a long time, and I've been here for about 30 years. What I want to do in this limited time is just give you a perspective on what's been happening in Asia Pacific, especially China's challenges as a result of a change in US policy, and also the COVID infection, which caused significant economic slowdown pretty well everywhere. So the topics that I want to cover are essentially 5 in number. First of all, to look at some potential scenarios for a return to growth. COVID is slowly being managed in different geographies, and it's very clear that post-COVID, Asia will lead the return to growth, and the highest growth economies in the world, in fact, in the next couple of years, here in China, which between them have about 2.6 billion people. But secondly, the global debt overhang shows no signs of ending. That's mainly because governments continue to pump amounts of money into global economies. Today, I was watching the US administration negotiate $4 trillion stimulus program. That's to 30 medium-sized enterprises. SMEs are key to recovery. We tend to talk, when we talk about business, and particularly media, tend to talk about big name companies, Apple, and other large ones. But the reality is that 90% of companies globally fall into the category of small and medium-sized enterprises, and they employ most people. So one key index of what's happening recovery-wise is how SMEs are doing, and I want to explain how they have been victims over the last few years of excessive market power by larger companies, which have disadvantaged them in a working capital sense. Fourthly, we now have a growing issue with FCC, financial crime complaints, know your customer, which recent poll reveals are top of mind for CFOs in Asia and globally. Why is that? Well, because governments, the American government through the Fed, the Europeans, and increasingly individual governments in Asia are passing legislation to insist that all companies, not just regulated ones, but non-regulated ones. That means a non-regulated one is any company that isn't a bank or an insurance company or another independently regulated entity. So those companies need to know who they're doing business with in terms of who their suppliers are, who their customers are, and who their shareholders are. And if they fall foul of the law by doing business or investing with someone with a criminal relationship, then they run the risk of being litigated against and fined large sums of money. Fifthly, and this is the positive part of this, is that as companies in Asia try and find their way out of the current crisis, they are much more open to automation than at any time in the past. This is partly because of desperation, and also partly because remote work caused everyone, including the over 60s like me, to see how automation can enable a different kind of business model. So without further ado, I'll press on. So here we have some data on return to growth. And if we go through these numbers, if we first of all look at the global regions, and we look at the forecast for 2022, and obviously these are forecasts because we might have other recurrences of disease. Emerging Asia expected to grow at 7.4% this year and 5.1% in 2022. The United States maybe 4.2% this year. We have two other scenarios on the right-hand side of the page, which say 6.4 for emerging Asia or 4.6, but it's in the same kind of main focus today. The third chart in the bottom left of the slide takes some of the large significant emerging economies globally and looks at their potential rate of growth. In 2021, India is expecting to achieve a scorching 10.2% GDP increase, and China possibly as much as 8.8. Now you'll appreciate that the numbers on this page are slightly different. That's what happens when you go to multiple sources for forecasts. Bottom line, Asia is going to grow faster than everybody else and is going to bounce back from COVID faster than everybody else. Now, since our topic is accounts receivable, here's a snapshot of what's going on with economies around the world. Now, this is quite a busy slide, so let me explain it to you. We have a list along the x-axis of countries, and we have data on the lowest quartile DSO in those countries. That's the bottom 25% of companies, which is at the bottom of the chart, and the top DSO range, which is in red, and then the average DSO for companies in those countries. And in the middle, we have a global average. I bet you've never seen a global average DSO before, so that's worth looking at, isn't it? And what's significant about this is if you look to the very right-hand side of the chart, you'll see that China, and remember China, we said China was going to grow very fast indeed, and China is going to be the world's largest economy some point in the next 20 to 30 years. I don't want to get into that because everybody fights about this, but the bottom line is its rise is fairly relentless and it's growing significantly more quickly than any Western economy, including the US. The range of DSO in China is far greater than anywhere else. If you look on the left-hand side, for example, third from the left, the USA is between, I think, 29 and 67 on average, whereas China is between 42 and 135. What does that mean? It means China's not really settled down. It means China's a bit all over the place. And it means that in relative terms, Chinese growth is going to be bought at the price of much more working capital because DSOs are simply not disciplined in the same way that they are elsewhere. And if any of you listening to this want to understand how to operate in China, I've been working there for something like 30 years. So ask a question at the end or feel free to contact me separately. The debt overhang shows no sign of ending. Now, you know, a couple of years ago, I wrote an article for Global Finance, which is a New York Wall Street magazine read by many in the US. And I said that given the data, there was going to be a debt crisis at some point. Boy, was I wrong. It appears that there's an unlimited ability of governments in America and Europe to go on printing money. But which is the level of debt today carried by non-financial corporations, companies that aren't banks, in essence, is slightly higher than that before the great crash occurred back in 2007-8. You can look at the top line, yeah? And those data are split between large and small corporations. The debt continues to climb relentlessly. And this was before last year. But more worryingly, if you look on the right-hand side, the quality of debt is declining. So if you look at a comparison between 2018 and 2010 on the right-hand side, the percentage of corporate bonds that are investment grade went from 78.4 to 76.5 between those 2 years. That means that at least a quarter of corporate bonds, as an aim, were already well below investment grade. Corporate bonds, these are securities based on money lent to corporations, non-financial corporations. I can assure you that as a result of what's happened due to COVID over the last year, those data have eroded further, creating a pretty high level of risk for some of those instruments. Next, here's a chart which is quite interesting. What's interesting about this chart is it's how companies in different sectors globally view their risk of having liquidity issues. And what's interesting about it is this data was assembled approximately a year ago, and they were asked to look out for a year and to say currently a liquidity issue, whether they thought they'd have one in around 3 months, that's the orange bar, whether they would have one in 6 months, that's the blue bar, and whether they would have one in 1 year or more, that's the 12 months, that's the yellow bar. Now, it's more than 12 months. Actually, no, I tell a lie, it's exactly 12 months since this data was assembled. So you can see that anyone that's got any yellow is now in territory of potential liquidity issues. There's only one sector that isn't is strife, and that's telecoms, which kind of makes sense if you think about it, because the more remote working we have, the more telecoms get in revenue. Financials are reasonably strong, but starting with consumer staples all the way up to energy and consumer discretionary, high levels of concern about liquidity. And we're seeing that in terms of bad debt, in terms of increased receivables. So the debt overhang shows no sign of ending, and predictions of dire disaster have proved unfounded. I'm not too sure how we interpret that, other than to say there is a lot of froth in corporate debt, in real estate, and in other investment classes as a result of the fact that governments have made enormous amounts of liquidity available at relatively low costs. If I move on to the question of SMEs, what is it about SMEs? Well, if I look at Singapore, but pretty well all my consulting work has been advising companies in the larger geographies of Asia, like China, like Japan, like Indonesia, like India, and so on and so forth. But SMEs, small and medium-sized enterprises, and by the way, in Singapore, they're defined as companies with less than about $70 million in sales. So the bigger SMEs are respectable. In other countries, the definition may be slightly different, but they represent 99% of the 220,000 companies registered in Singapore. ACRA is the official company registry, don't worry about that. They provide 65% of total employment here, and they generate about half of GDP. So the fate of SMEs, small and medium-sized enterprises, is critical when it comes to looking at how most people who have jobs are going to fare going forward. And because Singapore, like many other countries, has provided significant subsidies over the last year to ensure that people don't get fired and that companies continue, they are now withdrawing those subsidies because we're coming to the end of COVID. So a lot of companies are expected to file for bankruptcy. Now, if we look at emerging markets in general, so excluding mature markets like the US, like markets in Europe, SMEs across emerging markets in general provide 4 out of 5 new jobs. They create 40% of national income and 60% of total employment. So slightly lower than Singapore, but comparable. They have another issue, which is that because in many cases they lack infrastructure, they're not quite so professionally structured from a financial perspective, and often their finances are less transparent than bigger firms. They are very often less able to obtain borrowing than large firms, which means 50% of SMEs lack access to formal credit, and 70%, including small and medium-sized enterprises. Those are the very small guys. Yeah. So you have to see that if receivables become a big issue and I can't operate my business due to a lack of liquidity, I may be at higher risk of becoming insolvent than a larger company because I do not have access to independent financing. So if we look at that in another way, this is an interesting chart, and let me take a moment to explain this. So I wanted to talk about DSO, and what this does, and I'm indebted to PwC for this. The different lines relate to different size companies. So the green line at the bottom is companies that have revenues of greater than $1 billion US. The orange in the middle is companies that have revenues of between $500 million and $1 billion. And the top line is companies that have revenues of less than 500 million. And the last data on the right is for 2019. I couldn't get 2020, it's too soon. But what's going on here? Well, companies that are very big, that's those on the bottom, bigger than $1 billion, their DSOs remain pretty much the same, 41 to 42. It's neither here nor there. So it's jumped about between 40 and 42. In the middle, pretty much. But at the top, these are the smallest companies. DSO over this period has gone out by 10%. And remember, these data are before COVID. So I'm quite confident that when we see these data in a few months for 2020, going to see DSOs for the smaller companies going way up into the 90s, possibly as high as 100. What does it mean? It means the big companies, by and large, are able to hang on to their cash, and small companies aren't. Things are linked. Big companies are increasingly using their leverage in the market to withhold payments from smaller suppliers who have less power. This is something that should concern anyone, because remember, a minute ago I explained how it is that SMEs provide the bulk of employment. So it might seem like a good idea if you're a large MNC to withhold payment from your SME supplier in order to please your shareholders. But if that's done too much, it may come at the price of significant insolvencies and job losses in the economy as a whole. So just to summarize on that asymmetry question, and by asymmetry, you know, like the same term is used in asymmetrical warfare, it means big companies are very powerful, small companies are relatively weak, and big companies are therefore able to exercise that power to create an asymmetry in terms of DSO performance. 90% of all employment comes from SMEs. Singapore SMEs in particular say it's getting harder to collect customer money. Many payments are late and bad debts going up. SMEs see the situation getting worse because of the legacy of slowdown and trade war. Many SMEs here and larger companies have had to shift their supply chains as a result of US sanctions on China, and that's proved to be costly and high risk. Insolvencies rise, and many respond to cash pressures from late customer payments by delaying paying their own suppliers or borrowing money to plug the gap. Neither of these are sustainable strategies. Finally, though, although they're in trouble, SMEs are sufficiently worried about losing customers to want to press their customers for payment, which puts them in a bit of a quandary. And that's where people like me come in. We try and help SMEs. I've thrown in an extra slide here because one of the things about Singapore and other cities in Southeast Asia is that startups, particularly fintech startups, are a significant part of the economy. And many people know anecdote that most startups go bust. I thought I'd just put in some data, some fairly recent data on what the top 20 reasons why startups fail are. The first one, unsurprisingly, is that there's no market for the product. And that could, of course, be caused by something like a COVID situation where the channel is closed. But the second one, and pretty consistently the second one, is that they've run out of cash, liquidity, working capital. In 1/3 of the cases, at least, is the reason why startups fail. So liquidity is not just an issue for established companies, it's an issue for startups. So SMEs often turn to factoring and invoice exchanges, and depending on which ones they go to, sometimes the interest rates can be extortionately high. Many entrepreneurs at the bottom end of the market are taking out loans, but the data for Singapore and other countries in Southeast Asia are quite frightening in the sense that something like 70% of all loans taken out by SMEs are secured on the primary residence of the owner of the SME. So those small companies that provide all the employment, the owner and his family or his mother, or whoever owns the house, has a home at risk if that company goes bust. So a big question is just what's going to happen when companies in general run out of cash or if government support is withdrawn. The problem that I have, whilst I applaud supply chain financing, and I think it's great that invoicing exchanges and factoring services and other financing platforms are providing a range of services to SMEs, the problem is they're treating the symptom of a working capital gap, not the cause. And if you're in a sector where the dynamic is that you are constantly having to put in more working capital in order to trade, then that's not sustainable. Just a snapshot, and this is just coming up to 2019. Again, I apologize, I don't have last year. You can see that the corporate debt to GDP has been increasing. It's gone from 100% of GDP, or 98, to more than 150%. So in general, I don't have the data here, but if you were to look at GDP growth and corporate debt growth, you see that the two are not running at the same rate. In other words, GDP growth is being bought very expensively at the cost of debt. Yeah. You know, one idea, and I say this slightly tongue-in-cheek because this is something that I and other friends have been pushing in Singapore through Receivable, is to get SMEs in Singapore into better shape. We've been encouraging big companies to pay SMEs within 30 days. And where SMEs are in trouble because big companies aren't paying them, we've reached out to SMEs and say, anonymously name the big companies who are paying you later than the agreed terms, and we'll find out what we can do to influence their behavior. And it's been very interesting. It's been as interesting to discover who signs up for this as it has been to discover who doesn't sign up for it. Some global names have signed up for this, but only on condition that we don't tell anyone, because Singapore is relatively small and they don't mind sacrificing a bit of cash to pay suppliers in Singapore, but they don't want it to be globally known that they're paying suppliers as the cost would be too high. Make what you will of that, but it's quite interesting. So let's talk about financial crime compliance and KYC, know your customer. Here's a snapshot taken from a seminar I gave recently on some of the legislation that applies to every company, not just banks and insurance companies, not just regulated entities, now in the world. So it's the US Foreign Corrupt Practices Act, the FCPA, the UK Bribery Act 2010, the Terrorism Suppression of Financing Act, this is an alphabet soup, and the Monetary Authority of Singapore. Singapore is a disciplined and honest place in comparison with many emerging markets. And Singapore governance is strict, tries to emulate the leading global centers like London and New York in terms of the strictness and the probity of its environment. So Singapore is quick to put in place similar legislation. What these legislative points mean, two things. One, you need to be aware, whatever kind of company you are, that you can get into trouble if you do business with the wrong people, and ignorance is no excuse. And secondly, if you fall foul of the regulator, you're likely to be shamed and fined. And in other words, you've got two risks. One is reputational loss, and that's a big issue if you're selling, say, to retailers, or particularly if you're selling to a particular demographic that is sensitive to these issues. But the other thing is the fines are often swinging. And if you think about it this way, governments everywhere are short of cash at the moment because of the subsidies they've had to roll out to support their economies during COVID. So I hereby prophesy, and this is based on individuals who are close to the regulators in the Fed in New York and other regulators in Southeast Asia, I hereby prophesy that you're going to see some swinging fines this year as governments clamp down in order to increase their revenue. And interestingly, I chair a number of groups of executives in Singapore region. One is a group of CFOs, other ones are CEOs. But my CFOs, a couple of weeks ago, came up with this list of things that concern them and they wanted to know more about. The first is risk and know your customer post-COVID. So they see this as coming up as a big issue. Now, for those of you who are listening to this who are concerned with receivables management, remember that the things that you need to know to reduce receivables risk with customers, that is, you need to know who they are, how solvent they are, who else they do business with. These are consistent, if you like. You need to know that you're aware of who your customer is. So there is a synergy between being effective in managing receivables and demonstrating to any regulator that you are doing everything you can to make sure you know who your customers are. The second one is sustainability real? This is not really the topic for today, but it's an interesting one. I think what it means is the days of greenwashing, of communicating that we're doing good stuff, but without substance, are kind of gone, and people are looking at tangible investments. The third one is the strategic view of the CFO, and the worry here is that increasing regulation is making it harder for CFOs to get their heads out from compliance and go back to being a strategic advisor to the CEO. Fourthly, credit managers are closely associated with the trading risk and receivables. Finally, ESG, economic social governance, have finance lead. The reality is that leading investors are not prepared to buy into equities that do not satisfy ESG requirements. There are 17 sustainability requirements from the UN, and you as a company or your customers or your suppliers need to decide which ones they're going to tick. They can't ignore them. Not the same group, but another group of CFOs who came to a seminar that I gave came up with this. They can't get data on customers. So Asia is not like America or Europe. Every country has slightly different legislation. Some companies in some geographies can operate in a fairly opaque way without recording too much information. In other countries, famously, including China, they have 2 or 3 different sets of books, depending on whether they're talking to the tax collector or a potential purchaser or just a customer. So data is a problem. Credit terms are definitely getting longer. So if you want to continue to do business with me, you're going to have to give me more credit. This is how bigger customers in particular exert that asymmetrical pressure that we were talking about. We have growing challenges getting paid on time. They think hanging on to their cash is longer is fair. The thing is that this is an existential issue for SMEs because, as we said, they do not have access to the kind of borrowing opportunities that larger companies have. And finally, we don't know how bad debt is going to be, but since we know that lots of companies are going to go bust, it follows that there's going to be a significant increase in bad debt, not a particularly pleasant situation. Finally, and I only need another 5 minutes. I just want to. This is a pretty mixed bag, isn't it? We've said that Asia is going to grow faster than anybody else, but we've also said that the risks in Asia are very, very significant, and that SMEs, who are the life's blood of most Asian economies, are at high risk of high rates of bankruptcy as we emerge from COVID. So, a very good analysis was done of companies during and after the 2007 crisis, which you may remember was a stock market crisis in the US and Europe. A minority of companies, 13%, increased their market value very significantly. This is based on 100 being the average. And how did they do it? They did it mainly by focusing on balance sheet and by leveraging automation opportunities. So, without further ado, there is a burning platform for automation. As of the middle of last year, April 2020, sorry, a year ago, there was a significant increase for many companies in their readiness to automate. Obviously, cybersecurity was at the top of that, but the second one is general process automation. So there is, and I think for a couple of reasons, because there's a pressure on operating costs. So if I can take out heads, that's important. And secondly, as companies come up, that a lot of things can be done remotely and automated, where previously they thought they all. How do they know that? Well, because they've discovered that when they take people out of the office and put them at home, because they're compelled to, that things don't fall over, they still operate. So there's an openness to do things. So if you're selling automation, good time. And on that note, 74% of in the plan to permanently shift to more remote work. In other words, what's happened is that they've learned from the way that remote working has operated over the last year in many places, it's a year here, that they can keep some things remote because it makes their employees happier and it reduces their costs. So, for example, they can take out a smaller office and they can reduce their overall headcount requirement. So only 26% said that 0% would remain remote. Everybody else said that some stuff would remain remote, and about 50-odd%, it's 74% who think that some of their activities will continue to be remote. I mean, that's very significant. That is a huge change, and it opens a huge door for all kinds of technology. I think the final thing, and in case anyone's asking, there's a company that specializes in analysis. They go, I don't know any Lord of the Rings fan listening to this, I'm a huge one, but a company called Mordor Intelligence, probably run by Sauron, I don't know, have done analysis of the opportunity for growth in commercial automation, and the Asia Pacific region is by far the biggest. And if you look at this map, you've got China and India in the north, you've got Southeast Asia going all the way down to Australia and New Zealand. So on that positive note, I'll relate to you a little bit. Thanks.
Thank you, Simon, for a great presentation. That was very insightful. So to begin with, let's go over the first question that we have. What can be done to reduce DSO in China?
Yeah, so that's a very good question. If you are in China, China is likely to be a good source of growth for you. Years ago, I did a survey in China because there's lots of misconceptions about DSO. You know, one of the first misconceptions, and I have just sent a book to the publishers, which will come out in a couple of weeks, is how do I get paid on time in China and elsewhere? Well, as long as you're the question is, how do you become one of the somebodies that pays you? And the short answer is through a set of relationship activities, because the fact of the matter is that if you manage your process right, you can put yourself first in line to get paid. How do I know that? Well, because I did a benchmarking exercise in the US some years ago, and we looked at companies of different sizes, and we looked at companies of different power in the market, expecting to find in the ways that they were paid by their Chinese customers based on their size. But the correlation wasn't with size, the correlation was with our assessment of how effective their processes were. To put it clearly, if you take credit terms seriously from the very beginning of the relationship and communicate that to your customer and have follow-up processes that ensure that you're consistent in that, you're likely to be paid in time. Do not, you have a fairly relaxed approach and you don't deal with payment until it's already late, even if you're a big company with lots of power, so that there's no correlation between size or market share. The correlation, what tells you who gets paid on time, they are when it comes to key accounts receivable processes. And automation, of course, is useful as well.
Thank you, Simon. Let's get on to our next question, which is about what are the 2 to 3 actions that I should take to manage the credit risk of selling to small and medium businesses in Asia?
Yeah, I mean, you have to ensure you know the business fairly well. These businesses, you have the option to limit the amount of from cash terms to very short credit. I'm very safe if it's a new relationship, is to limit the terms until you're confident. Secondly, I think these are a very key thing. You need to remain close to them to understand just how well they're operating, and on the back office, so that pay you late if they can afford it. But many SMEs, unfortunately, they go into business because they have a smart, an entrepreneur starts an SME because he has a bright idea. And I know what I'm talking about because I'm a serial SME starter. I've started 6 I came to Southeast Asia. I have one, Receivable, which is the one that you see in this presentation. They start companies because they have good ideas, not because they think they're experts on invoicing and getting paid. And very often, they leave paying their suppliers as an afterthought. So they're not necessarily very conscious of the need to manage cash flow. You should be, if you are a large company with experience and you're dealing with an SME, you should take it upon yourself to educate your customers. If you don't think they've really got themselves very well organized, then you need to make sure that you help them get organized so that you're first in line to get paid. If you adopt a kind of wait and see, never adopt a wait and see approach with receivables. That is the worst thing you can do. Okay?
Thank you, Simon. I think the next question that we have is very interesting, and it'll be great to get your insights on top of it. And you've been talking about this as well. I mean, why do you say that Asia will be the largest growth market for AR automation technology?
Well, I kind of addressed that. I mean, I'm not claiming to be a guru on this, but I suggest anyone that really wants to know this Google's Mordor Intelligence or one of their competitors. There are a number of companies that specialize in this level of market intelligence. I do have the data, but it's trademarked, so it's not appropriate for me to share all the data. But they've done some pretty exhaustive analysis. I mean, one reason I can tell you without even giving anything away is the sheer rate of growth. You've got 10% GDP growth in India. You've got 6-7% in China, and it's compounding year after year. Many new companies are opening up all over the region, and as they open up, there will be more demand for solutions. I mean, the second thing is that because the average age in Asia of entrepreneurs is younger, they are more open to automation. You're dealing with a very different by slightly older people. Many companies in Asia are run by younger people who are much more switched on when it comes to technology than the average senior executive is in the West. So you've got an openness. So you've got the growth and you've got the propensity to invest in automation. 2 really good things to have if you're looking to sell automation solutions. Yeah.
Thanks a lot, Simon. I think we are already on top of the hour over here. So I think let's get to our last slide, the wrap-up slides. And again, Simon, thanks a lot for joining us today. And I would also like to thank all the participants for joining today and appreciate all the patience. And hopefully you've got some great insights from Simon. And if you do have any questions as part of the follow-up for this session, you could write us an email at info@imagia.com. And also wanted to invite you guys to our next masterclass, which is on 22nd of April at 10 a.m. Pacific time, which is going to be again a Thursday. The topic for our next masterclass is defend your profit with digital detections. So looking forward to seeing you all over there as well. And thank you very much. Thanks a lot, Simon.
You're welcome. Thanks, everybody.
Take care. Yeah. Okay. Bye-bye.